Yeah, I mean, gold almost crossed $3,700 an ounce this morning. It'll probably, cross it either later today or by tomorrow. I think that, the central banks are voting with their feet when it comes to their preference to own gold. They're getting rid of their dollars. They're getting rid of their treasuries, and lower interest rates are just going to accelerate that move. I don't even think gold stocks have caught up to $3,000 gold yet, let alone 3,700. And we could easily be at 4,000 by the end of the year. So, I'm not telling people to stop buying physical gold and silver now because it's not that obvious, but at that moment in time, to me, these mining stocks were so ridiculously cheap that I couldn't see putting any money into physical gold when you could just buy these miners.
Dollar weakness is fueling a surge in gold and gold mining stocks. Peter Schiff, an economist and investor known for his criticism of U.S. monetary policy, warns that the Fed's recent decisions could further weaken the dollar. He notes that central banks are reducing their dollar holdings while increasing gold purchases, pushing gold prices close to $3,700 an ounce. With record U.S. deficits and nearly $38 trillion in national debt, much of it short-term and soon to mature, the country must borrow heavily to cover both new spending and refinancing needs. Global investors are moving away from dollars and treasuries, focusing on other markets, while central banks continue buying gold as a hedge. Schiff highlights that while gold prices have risen significantly, gold mining stocks have delivered even bigger gains due to their historical undervaluation. Back in April, gold exceeded $3,000 per ounce, but mining stocks were still priced as if gold were around $2,000, offering investors substantial upside with limited downside. Since then, gold has increased roughly 40%, while mining stocks have more than doubled, reflecting their leverage potential and making them an attractive investment. He emphasizes that central bank demand for gold is likely to continue, driven by the need to reduce dollar exposure amid ongoing U.S. trade deficits. This creates a FOMO effect, as rising gold prices push more central banks to buy. As gold potentially surpasses $4,000 to $5,000, mining stocks could experience another significant surge. Eventually, these stocks are likely to attract attention from mainstream investors and portfolio managers, further supporting their long-term growth potential. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
Yeah, in fact, we're about to make another one. I mean, this may be the biggest error yet for the Fed. I mean, they're going to cut rates tomorrow. And not only should they not be cutting rates, they should be raising rates. I've said all along that, A, they waited too long to raise rates, which a lot of people now agree with. And of course, they never should have cut them the way they did. That was an even bigger mistake. But they aborted the tightening too soon. And I think the reason they did it was because the banks started to fail. That was really the catalyst. It wasn't because they won the battle over inflation. They were just afraid to keep waging the war because of the collateral damage. And I think that's the reason they're about to cut in the face of worsening inflation data. Not only is the official rate well north of their 2% target, and, inflation is further above 2% now than it ever was below it. And when it was below target, we had 0% interest rates. We had quantitative easing. It was this huge emergency that 1.5% inflation is just too low. We have a 2% target. So they had to do whatever it took to rid us of the menace of 1.5%, right? We had to have 2. But 3.5%, no, that's fine. We can cut rates. We don't need to fight 3.5% inflation with the same ferocity that we fought 1.5% inflation from the other direction. But the reason that the Fed is ignoring not only inflation above target, but rising is because of the cracks in the foundation of the economy. And the Fed has been able to kind of deny that based on bogus jobs numbers. Well, now that we've had a lot of revisions, the Fed can't pretend that the labor market is as strong as they've been pretending, and so now they're going to cut rates because of the weakness in the labor market and the economy. But the rate cuts are not going to deliver the expected relief. I believe that they will backfire in that they will cause long-term rates to rise, which is really what they want to reduce. And that will ultimately usher in a return to quantitative easing. And that's the nail in the dollar's coffin. And I think that's why you're seeing, the dollar is weakening today. I think right now it's the second lowest level of the year. If you look at the dollar index, now we have a back at a 96 handle. And yeah, I mean, gold almost crossed $3,700 an ounce this morning. It'll probably, cross it either later today or by tomorrow. I think that, the central banks are voting with their feet when it comes to their preference to own gold. They're getting rid of their dollars. They're getting rid of their treasuries, and lower interest rates are just going to accelerate that move. Can't just look at the raw numbers.
Yeah.
Because look at all the additional debt that, we have, issued over the years. So if China still has the same dollar amount of treasuries it had 5 years ago, in relationship to the outstanding treasury supply, it's really going down. And so that is the problem, because our deficits have never been larger than they are right now. We took the problem that Trump inherited, and I say inherited because Trump was obviously president before. So he, is partially to blame for the Biden deficits. But he took those deficits and he made them worse with the big, beautiful bill. So the United States has to borrow more money than ever before. Plus, we have the problem of having to refinance almost $38 trillion. The national debt is financed with short-term paper. So the majority of the national debt will come due during Trump's term. So not only does the U.S. have to finance $3 trillion, $4 trillion of annual deficit spending, but we have to find buyers for, $10 trillion a year of maturing debt or something like that. So it's enormous what we have to finance. And the world just does not want to do it. And they're diversifying out of dollars. And of course, we keep flooding the world with dollars because even though we have these tariffs, we still have $1 trillion a year trade deficits. And so what is the world going to do with all these dollars that it earns selling us all this stuff? Well, they used to buy treasuries. They used to buy U.S. stocks. Now they're buying their own stocks, and they're not buying treasuries. They're not buying dollar debt. And the central banks aren't buying it either.
Yeah,
the central banks are buying gold. The easiest money has been made. And you're right. When I was on in April, I had just come out with a special report that I was, circulating on the internet. People can get it on my website at Europac.com, the best way to buy gold. And I did that because, gold was over $3,000 an ounce. Yet the gold stocks were where they were when it was $2,000 an ounce.
Yeah.
And so in my mind, why go pay $3,000 an ounce for gold when I can buy gold in the ground that's still valued at less than $2,000? In fact, way less than that. I thought that if you looked at what you were paying to buy these gold mining companies, that gold still in the ground had never been so cheap relative to gold above ground. So it wasn't that I didn't think gold was going to keep going up. I just thought, why buy it when they're giving away these gold mining stocks and they're so cheap, and the downside I thought was so minimal? It made a lot of sense. And, now I think year to date, gold's up, almost 40%, but gold stocks have more than doubled. So, and so people have made a lot more money, starting in April, because even the first quarter, the gold stocks didn't even move. It started in Q2, and the whole doubling was basically in the last maybe 6 months. Didn't even take a whole year to double. And so, but I don't even think gold stocks have caught up to $3,000 gold yet, let alone 3,700. And we could easily be at 4,000 by the end of the year. So, I'm not telling people to stop buying physical gold and silver now because it's not that obvious, but at that moment in time, to me, these mining stocks were so ridiculously cheap that I couldn't see putting any money into physical gold when you could just buy these miners. I just did not see the downside risk, and I thought there was huge upside potential. Now we've realized some of that upside potential, but I think in the scheme of things, these stocks are still very cheap. If you look at the PEs of the big gold companies, they're very low. compared to historic averages, compared to the market multiples. The investors are not in. I mean, they've still had net liquidations all year out of GDX and GDXJ, these gold mining ETFs. Nobody talks about these stocks. Nobody owns these stocks.
Yeah.
Newmont Mining is the best performing stock in the S&P 500, yet it's probably the stock that's least owned in the S&P 500.
Yeah, and the margins. I mean, the margins are incredible here.
Oh, look, they're going to make nothing but money for years to come. They are producing a product that everybody needs, whether they realize it or not. I mean, the central banks are huge committed buyers. Right? They're not going to stop buying gold because they're not going to stop divesting of dollars. And they keep earning dollars, right? Because we're hemorrhaging dollars due to our trade deficit. So not only do they have to get rid of the dollars they own, they have to get rid of the dollars that they keep getting. And so they're going to keep buying gold. And as the price of gold rises, it's just going to suck more central banks into it, because the central banks that aren't buying gold are falling behind the ones that are. And gold is becoming increasingly more important as a reserve asset, not just because central banks are buying more of it, but because the price of what they own keeps going up. And that means that the value of their gold as a percentage of total reserves keeps going up. And so, there's going to be a FOMO in central banks to get into gold. And they're just, they're price agnostic. I mean, they're not going to stop buying because the price goes up, because they're just trying to get rid of their dollars before the price goes down. But at some point, the investing public is going to join this party. I mean, I think to an extent, some money is already coming in, and that's why the gold stocks have had the move that they had. But this is just the tip of a huge iceberg that we've seen. And so far, the buyers have been patient, and they've been buying on the pullbacks, and there hasn't been any crazy up days. There's no real euphoria, and I still see sharp corrections like what we're having today. Gold doesn't even go down, right?
Yeah.
And all of a sudden these stocks are down 3 or 4% just because people are afraid. Oh no, this is it. But the minute gold doesn't go down and goes back up, then the buyers come rushing in. The coast is clear. But we're going to get into a stage maybe next year, with gold well north of 4,000, maybe 5,000. Maybe the gold stocks double again from here. But at some point, they're going to get on the radar of the average portfolio manager, and they're going to start buying.
Peter Schiff warns that the U.S. faces not only the risk of a Treasury default but also the danger of repaying debt with devalued dollars created by the Fed, undermining confidence in the currency. He views this as both a sovereign debt and U.S. dollar crisis, fueling higher gold prices, which have recently approached $3,700 an ounce and could climb toward $5,000. With limited new supply and strong demand from central banks, particularly in emerging markets, gold's role as a safe haven asset continues to strengthen. At the same time, Schiff points out that opportunities extend beyond physical gold. Many smaller gold companies with proven reserves remain undervalued, offering significant potential as larger, cash-rich mining firms pursue acquisitions rather than risk costly exploration. This expected wave of industry consolidation, combined with rising gold prices, could generate substantial gains for investors in gold mining stocks alongside the ongoing strength in the physical gold market. Let's get back to the interview.
Well, there shouldn't even be a second mandate, let alone a third. The only mandate and should be no inflation or price stability, which should be defined as zero inflation. Although I don't think 0% inflation is necessarily better than falling prices. I'd rather see the cost of living go down than stay the same. But at a minimum, they should target stability, not 2% inflation every year. That's a 2% decline in your standard of living if everything is 2% more expensive. But the Fed can't really target interest rates by monetizing debt, because in order to do that, it creates inflation, which ultimately puts upward pressure on the very long-term interest rates they're trying to suppress. So really, the best way that the Fed could try to create an environment where we have a sound economy with low unemployment and low interest rates is to have sound money, is to fight inflation. But that's the one thing that Trump administration doesn't want the Fed to do. The last thing that Trump wants the Fed to do is fight inflation. Trump wants the Fed to blow air into the bubble so he can take credit for a phony economic boom. And what he doesn't want to have to accept responsibility for is a bust, even if the bust is cathartic in that, we fix the problems that underlie the economy and we lay a foundation for lasting economic growth in the future. Trump doesn't care about economic growth in the future because he won't be president in the future. He's president right now. And so he wants to take credit for an economic boom. And the only way we can have one is to have a phony one. All we can have is a bigger bubble. And so that's what Trump's fiscal policy is trying to achieve. And that's what he wants the Fed to cooperate. He wants a massive bubble that he can put a big T on. And everybody can think they're getting rich as, they're going broke. I mean, I blamed them before the 2008 financial crisis before it happened because I knew the crisis was going to happen because I understood the monetary policy mistakes that the Fed was making. But be that as it may, the only thing worse than the Fed we got would be a Fed controlled by the president.
Yeah.
I think to the extent that there's any independence at all at the Fed, that's better than no independence. Now, ideally, right, if it was up to me, there would be no Fed. But that doesn't mean that I would just hand the printing press to Congress or the president. I think we should have the same monetary system that existed before the Fed.
Interesting.
And before we had a Federal Reserve, the only thing the U.S. government did was coin gold and silver, which is all that's authorized in the Constitution. And to the extent that we had banknotes that circulated, they were all issued by private banks. They were not issued by a central bank, and they were never issued by the United States government. I think there is a possibility that there is an outright default on U.S. Treasuries. But I think that what the markets are more concerned about is not that the U.S. government defaults, but that it pays with dollars that have very little value, because the money to cover the principal and the interest is created out of thin air by the Fed. And because there's no real buyers for maturing treasuries, the Fed doesn't become the buyer of last resort. It becomes the buyer of only resort, and we destroy the currency. And so I think this coming crisis is a sovereign debt crisis and a U.S. dollar crisis. And that is also why the price of gold almost touched $3,700 this morning and is headed much higher. There's a lot of smaller companies that aren't as speculative as you think. I mean, if you're talking about a pure exploration type company, yeah, because you don't know what they're going to find. Maybe they find nothing. But there are a lot of very small companies that have proven reserves that they just haven't raised the capital to dig up yet, right? They're at the earlier stage. You're not at the exploration stage, although they may be exploring for more, but they have provable assets, and they just haven't developed them. So they're not, in production. They're not generating any income. And I think there's some incredible value there because I think these companies are going to get bought up. I mean, it'll be a much friendlier environment to raise capital in the future, and they will be able to raise capital to build out these projects. But I don't think they'll have to, because I think the bigger companies that really have not been investing much in exploration and development, they've just been paying down debt, and now they're buying back stock. I think they're just going to have so much cash that they're generating, they're going to have to do stuff with it. And I think it's going to be cheaper to buy out other companies than spend money on exploration and development. I mean, because you roll the dice on exploration, you don't even know what you're going to find.
True.
Why do that when you could just buy up these companies and get their whole book of business, right, on the cheap? So I look, there's just going to be so much money made, I think, in the consolidation of this industry, which I think is going to happen before there's any really major increase in exploration and, of new projects, which is another reason, the price is going to keep going up.
Yeah.
Because there's not going to be, it's not like when gold is $5,000 an ounce, there's suddenly going to be all this extra gold. that's being mined. It's not going to be there. Yeah, there may be some more marginal supply. Maybe Americans will start selling off their jewelry at $5,000 gold, to pay the grocery bill, but that's not going to make much of a difference
Yeah.
in the scheme of things. And so there's not going to be a lot of new production.
Yeah.
And one of the sources of supply used to be central banks selling. Central banks are not selling. Again, they're buying, and they're going to keep buying, especially these emerging market BRIC nations. They still have, very small percentages of total reserves in gold. Even though they've been buying, they have a lot more to buy.
Yeah.
It's just that the major central banks, like, in Western Europe, United States, where we still have a lot of gold, but we haven't been buying.
Yeah.
Right? The United States hasn't bought any gold.
Gold and silver continue to stand out as key assets in an environment defined by rising debt, a weakening dollar, and persistent inflation. Central banks are steadily shifting away from dollars and treasuries, driving demand for gold higher, while mining stocks remain undervalued relative to the metal itself, offering meaningful upside potential. With limited new production and continued purchases from both major and emerging market central banks, supply constraints are set to support even higher prices. At the same time, U.S. fiscal and monetary policies, marked by excessive debt issuance and interest rate manipulation, intensify currency risk, reinforcing gold and silver's role as safe haven assets and long-term stores of value. How are gold and silver being shaped by rising U.S. debt and central bank buying trends? Stay tuned. If you're looking for clear, data-backed insights into the financial system, make sure to like and subscribe so you never miss our weekly updates. Thanks for your support, and we hope you enjoy the video.